Multiple time frames. So understanding the goal of multiple time frames. It's all about alignment of pictures and the time frames that you want to use. Those pictures mean aligning the trend or counter-trend trades in alignment in those multiple time frames. Now, those trends have to be aligned with your investing or trading goals. Meaning, if you're trading XYZ for months or weeks, looking at a 5-minute time frame is not going to be to your advantage. Actually, what happens to most investors and traders that look at those smaller time frames, they give up a position where there's really no reason to do so. And focusing on day trading, looking at the monthly time frame is going to be of little use if you're trading and your goal is to profit within the next hour or so. What are the cons or disadvantages of looking at multiple time frames? Well, the pictures change, and that can become very confusing where you're looking at a bullish picture in a higher time frame and you're looking at a bearish picture in a lower time frame. But that also could present, if you know how to use it, a buying opportunity in alignment with the higher time frame. Many subjective tools, oscillators and trend lines, and they change their position or information as you change time frames, and that is one of the main reasons we don't use them. So once we pick our time frame for a bias, we plan how to trade it, and we stick to that until it changes, or as if the pattern would become climactic, and that telling us that the trend is likely over. Now, we can go to lower time frames, but their trend must be aligned with the primary. Smaller time frames will come out of alignment at times, and what we do is just wait for them to come back into alignment. Then we can even add to positions in those smaller time frames where that happens. Now, if you're a core and swing trader, as I said, there's really no sense in much lower time frames, but we can go down to the 60-minute time frame. And that's what we use for our long-term intraday time frame. But going down below that, the majority of times, isn't going to work out in your favor. Guidelines. As I said, we're looking for alignment of trends and inflection points. As we look at many time frames, to have them all aligned, it's rare, and it's just not needed. And to expect them all to be, well, not only can it lead to indecision, but you might be waiting a very long time. And you might think, well, when that happens, the odds are going to be overwhelmingly in my favor. And well, that's probably true. There's no guarantees. As I said, it's not necessary. Pick your primary time frame. That's where your bias is and your objective. Make sure the time frame above your primary is in alignment with that. So the time frame below your primary, you can use it to refine or add to an entry point. Now, we don't trade from lower time frames without a plan from the higher. It typically leads just to poor quality trades, stop outs that were completely unavoidable. So we want to put these multiple time frames in alignment because that's what puts the odds in our favor. So here's a simple matrix of using multiple time frames. It's really so simple. What we're doing here is just deciding what is our primary time frame. Right? P, primary time frame. That's where we're looking for our compelling patterns to initiate those trades. And what we're saying is, don't trade against the time frame above it. So if you're a core trader, don't trade from, and you're trading from the weekly, don't trade against the monthly. If you're a swing trader and you're trading from your daily, well, don't trade against the trend on the weekly time frame, and so on as you go down into your smaller time frames. Once they are aligned, so let's assume here that we're trading a swing trade, and here's our daily, and our weekly is aligned, well, it is okay to go down to the 60 to refine or add at that point, and so on. We'll use it exactly the same way. Pick your primary time frame, look for a higher to be in alignment, and then it's okay to go down and add. Now, on this slide is understanding the transition, as it says, from green to red. And many traders or investors, anyone looking at a technical chart, will get confused or sidetracked by a red candle against a bullish trend. And what we're looking at here is just that this transition, in this case from green to red, can look many different ways. All of these patterns, as we covered in candlesticks, it's about retracements. So as we're looking at whatever the time frame is that we're using at the lower time frame, this transition can look like this, can look like that, and so on. So here you just got a 2-bar reversal here, a topping tail, prices went up and came back down. We have a little breakout failure here, and just a normal move up and equally sized bars at the top and reversing lower. Transition from green to red, and we're looking at a few different time frames. This would be our primary, going down to a lower time frame, looking at some detail where we can see the momentum slowing down. So in a higher time frame where prices are coming down, let's say into a reference point where we want to be a buyer, where would that be? Obviously in an uptrend, in an area of minor support, or it could be in major support. As prices come down, we can buy above the high of a red bar. As prices come down, that would be an early entry, but it's taking out some resistance, the high of the red bar. Looking at a smaller time frame, lower, we could see that slowing momentum beginning to shift by taking that X-ray into a lower time frame. And here, as we go down to even a lower time frame, we can see how the picture can change, and we can see even more detail in a lower time frame. Now, we still do not want to go down here unless our higher primary time frame is in alignment for us to even go and look here. Because if it isn't, these type of patterns can and do develop, and you'll probably be tempted to enter when you see them because you know this is a bottoming pattern. You know this is a shift in momentum. But if it's not in the proper location, trend, and support, these type of setups or bottoming patterns often will fail, or you get a momentary move up, because that's what the pattern suggests, and you get a momentary move up, and then it fails and moves down. So for example, we might see a daily time frame. If you flip this around and change the colors, and it was going up and then beginning to reverse lower, but within the inside of that reversal down, intraday prices began to turn up again. Well, the primary time frame isn't supporting these patterns, so we don't take them. What will typically happen is the primary will follow through lower, and these having this momentary move up will then fail and go down, and you get stopped out. Primary trend to the downside. Higher time frame going down. Here's a move into minor resistance. What was support becomes resistance, and then as prices turn back down again, this is the transition. And as we see that X-ray into the lower time frame, here's the transition as it turns up, and here we got a bottoming tail that was a little mini breakdown failure, and here was this transition back to the downside here. So looking inside of the bars, this is what we're seeing. Let's move on to part number 2, and here we're going to look at a lot of different examples. The focus of multiple time frames doesn't change, as already explained, but looking at a lot of examples here will reinforce those concepts, and we'll look at higher time frames and lower time frames and intraday time frames, and you'll begin to get a second sense of all of this and being able to put it together efficiently.